Hello and welcome to our macro and strategy update. In March, we had a number of central bank meetings. The cycle starting with the ECB in Europe, followed by the US Federal Reserve, the Bank of England, the Bank of Japan, as well as our very own Swiss National Bank. The main message coming from all those central banks is a confirmation that the ultra-accommodative monetary policy will remain in place for longer. For instance, in Europe, the ECB will even reinforce its purchases in bonds over the next weeks and months. The Swiss National Bank signaled more of the same and still considers the Swiss franc to be highly valued. In the US, the Fed concluded at its last meeting that interest rates will be anchored at zero for the next 2.5 years. Even though the message by the Fed and Chair Powell was clearly on the dovish side, we would like to highlight one point. In particular, the data published by the Fed show that actually a majority of FOMC members, while projecting policy rates to remain at zero until the end of 2023, have a bullish view on inflation. In particular, in 2 years' time, a majority of FOMC members, 10 to be precise, sees the core inflation PCE index to be above the target of 2%. The US is clearly ahead of others. For instance, the US economy will be at the point at the end of this year where it was before the pandemic hit. As inflation progresses this year, financial markets will increasingly focus on the appropriateness of zero interest rates for such a very long time. While we do not expect the Fed to alter rates in the short term, we do acknowledge that there is a risk that an earlier normalization of monetary policy could be in the pipeline. The implications for our asset allocation include the continuation of underweighting sovereign bonds. In addition, we confirm our more positive stance on the US dollar. Thank you for listening and see you next week.